Hello, and welcome to today's webcast, Considerations for Fintechs and Banking Partners. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, with that, I'm pleased to turn it over to today's presenters to introduce themselves and get us started. Theresa?
Thanks, Laura, and thanks everyone who's joined us today. Good morning or afternoon, depending on where you're sitting. My name is Theresa Wright, and I'm a partner here at Moss Adams. I practice in our financial services group and have been here for over 17 years. I spend most of my time devoted to working in the fintech as well as financial institutions. So I work on anything from a startup all the way to a public company. I'll now turn it over to Louisa to introduce herself.
Thanks, Theresa. Louisa Hanson, and I'm also a partner at Moss Adams in our assurance group in the financial services practice. Been here for over 20 years. Spend all my time in the financial services area, working with financial institutions, public, private, as well as fintech companies and partner banking relationships. Thanks for joining us today. With that, we're going to go to just cover the agenda real quick. You can read all the topics there. I won't read them for you. But we'll try to cover the majority of those items there, maybe not in that order. And then again, CPE credit. So watch for polls. Speaking of a poll, that we're going to start off with one. There should be 4 total. Laura?
Great. Yes, polling question number 1. Are you a fintech or a banking partner working with a fintech? A, fintech company. B, banking partner. C, other. D, I'm just here for the CPE. I'll give you a few moments to respond. To participate, please click the button next to the answer you choose and hit Submit. All right, we'll give everyone just a few more moments. Nice to see who's joining us today as we get started. All right, and here are the results.
Looks like a good mix of banking partners at 40%, with fintech companies coming in at 15%, and then 22% at other. Few of you are just here for the CPE, so we get it. We'll make sure you get that. We'll make sure you get that credit and let you know every time there's a polling, so you can get that CPE.
Thank you. Great. So with that, we're going to start off talking about just, understanding and working with a banking partner. This has both the perspectives of, coming from the fintech angle, explaining it from the banking partner's perspective, perhaps. When you're a fintech and you're a startup and you're growing, lots of ideas, lots of growth, it's very exciting. And then working with a bank can be a little bit, it's new and it's different, and the environment is totally, regulated, and it's just there's a lot to understand and to get comfortable with on both sides when you're starting that relationship. And just speaking of those relationships, there's different angles. And so as a fintech, working with a banking partner, they can be an investor in your company. So you've had to do some level of due diligence, perhaps, if that's the case, either direct investments or through a fund, perhaps, that does some of the due diligence and vetting of your company prior to receiving an investment. You can be working with a banking partner as a customer. For example, they need your services, or as a banking partner where you're needing some of their services, you're mirroring some of what they're doing, et cetera. So there's different levels, and then that comes with different levels of scrutiny as well. And so it's really important to understand the environment that they're in. It's a lot different, and it can be different depending on your relationship with the bank, as I mentioned. As far as just understanding the regulatory process, banks are regulated entities. The regulators are their partners, their primary partners, and they have the stronghold. They have the ultimate say in what can happen. So it's a lot different than basically any other company where you have your management team, your board, and barring just normal laws and regulation, you can do whatever you want. And so here we have to work with a different regulatory agency just to keep our insurance. And so understanding the regulatory agencies is important. There's a variety of agencies. There's the federal FDIC, OCC, Federal Reserve Bank, the FRB, and banks can have one or both of those regulators that they have to respond to. In addition, or the NCUA too as a credit union. And when I say banking partner, I mean both banks and credit unions. It's easier just to say banking partner. But in addition to that, there's also the state agencies that they have to comply with, and they have different rules, which we'll get to in a moment. And so it's just really important to understand as a fintech who you're trying to work with, so that way you can get a better understanding of what their requirements are and how to do that better. The regulatory environment has changed quite a bit the last couple years. Banking as a service, partner banking has gotten a lot more attention. And so, with that in mind, there's been more scrutiny and more revisiting of third-party risk management. Theresa is going to get into a lot more detail on that. They just came out with some new guidance in the last couple of weeks, which we'll touch on. But it's just really important to understand if there's ever any trouble, for example, at the bank from the regulatory environment side, they can stop, or they'll have to stop working, or they have to stop some of the contracts that are in place. They may just need to, pull back their reins a bit and get things under control before they can continue on. And so it's just really important to understand how that's operating. The type of bank charter matters. Again, also because where it's located, there's different rules in each state, just as far as what you can, what services you can perform or how you do that. For example, the lending side, Colorado, for example, has one of the most public cases where their state laws were trying to prohibit folks from lending to borrowers in their state and subject them to the state's usury laws, where other states can opt out of that practice. And so it's just really important to understand the different licensing requirements within each state. Along those same veins, why it might make sense to work with different banking partners or have multiple options as a fintech. And it kind of goes back to what I said, just with the regulatory environment. There's a lot of scrutiny out there. And this isn't supposed to be negative in any way. It's just supposed to share some of the perspectives and the risks that are out there that both sides have to operate in before getting into any type of relationship. But, as I mentioned before, banks can have, during their examination process, they'll get some feedback. And if the regulators are uncomfortable with something, they can formally prohibit, entering or performing certain services. And so the impact that can have on you as a fintech, if that's your only partner, if that's your only funding source, or the only way to access cash to do your lending, then that can put that just has a huge impact on your own business continuity process. So it's helpful to understand where they're at with their regulators, as well as understand, even from a board perspective, they may have their own level of comfort with how much of, each type of process they're willing to engage in. Or if you're growing so fast, you might exceed some of their minimum or their maximum requirements, and you'll need to go elsewhere anyhow. So it's really important to have a couple different options just from your own business continuity. Next, it goes into the bank's due diligence. And that's where a lot of this, the rest of this presentation will come in as well. There's a lot of public information out there to facilitate getting comfortable and getting to know what's required of each entity. And there's some links to some of those resources in the back, but it's a much different process than you're used to. It's probably more in depth than some of your capital partners required when they did their first investment. They may be asking for different financial information than you're used to providing, depending on what your fintech is doing. If you are a payment processor, if you're collecting funds from folks and depositing them in a bank, if you're kind of the intermediary for lending services, there's different requirements and different compliance aspects to consider for each type of those services. Payment processors, are you subject to getting a PIN audit? If you're a loan servicer, there's certain requirements as a servicer that banks and credit unions need to have in place that maybe other lenders don't. So, do you know what those are? Do you have those tested? On the deposit side, there's the know your customer, BSA issues. Who's performing that due diligence? Does your company have a process or a way or training in-house to help identify or help capture that information so you can provide that to the banking partner? Really understanding the contracts you're entering into is also super important, not only just to get the contract, get the service, get the partner in place, but really understanding who's required to do what. And, are you helping facilitate some of the compliance requirements at the banking partner? They're not allowed to just rely on yours, but it does, the requirements are pretty stringent. And so there is a lot of burden that's pushed out to various entities that work with the banking partners. And so that's why it's so important to know or to have those things in place so you can facilitate that relationship. Along those same lines, the reliability of financial information. So what you're providing to the banking partners during that due diligence process or their ongoing monitoring, how accurate are they? Do you have a good sense of, are you reconciling your own cash accounts? Are you being able to provide the information, when they're asking for it? Some of the compliance reports, if you're subject to any of those by third parties yourselves, are you able to get that or talk through that with them so they can get comfortable with that process? So there's a lot of information. This is a lot of background. And then Theresa is going to go into some of the more detailed aspects of getting to work with a banking partner.
Thanks, Louisa. Yeah, and Louisa mentioned, there's been a lot of scrutiny happening and a lot of things happening in the industry recently. The bankruptcy of a bank fintech intermediary firm that resulted in, frozen accounts. Fintech customers couldn't access, their money is prompting, big debate, big discussions occurring and how such partnerships are designed. So it is being looked at very high level with all the regulators. In a joint statement that was just issued last month, the Federal Deposit Insurance Corp, so FDIC, the Federal Reserve board and the Office of the Comptroller warned that end users could reasonably mistake certain non-bank third parties for FDIC insured banks. So they're really looking at this a lot with your bank partners and your fintechs, and really about the media, the information that's being disclosed. And we'll talk a little bit more about that in a little bit. The statement reminded banks of the potential risks associated with third-party arrangements to deliver bank deposit products and services. The agency, as part of their statement, and we'll go into some of the risks that they identified, they say that they support reasonable innovation and banks engaging in these arrangements in a safe and sound manner and in compliance with applicable laws. While these arrangements can provide benefits, they are seeing, as part of their supervisory experience, a range of different safety and soundness, compliance, consumer-related concerns. And so they've highlighted those that really each bank and each fintech should really be looking at to understand what does that mean and what will happen, if a bank decides to partner with a fintech, whose responsibility is it? And really, are banks going to have to kind of comply with those? Are they pushing it down to the fintech? And so we'll see lots of different items related to that. As part of the joint statement that they issued last month, they are actually asking for participants to seek information and comment on what bank and fintech arrangements are looking like, and also what are others seeing as risk management practices and areas of focus. So they are gathering that information right now to kind of look at that and decide what needs to be the next steps. We know that there are regulations coming down the pipeline. It's a little bit slow, but they're trying to understand from that perspective. So the agency has observed, kind of 3 areas of concern, or areas that they're focusing on and looking at. So the first one being operational and just compliance concerns. So we'll go through those. The second one being just growth, the tremendous growth that, Louise had said that you are all of a sudden having all these deposits coming into the bank. And then just the third one being end user confusion or misrepresentation of the deposit insurance coverage. As a consumer, they're really making sure, do the consumers know what they're getting into? So as it relates to operational and compliance, one of their biggest concerns is that there's significant reliance being put on third parties. And when you put the reliance on a third party, the bank's, deposit operations can eliminate or reduce the existing controls over and management of the deposit function. So if a bank is just putting it all on a third party, there's concerns that some of those controls that were in place may not be occurring. Louisa mentioned earlier, and we know with that bankruptcy, the lack of access to records is a huge concern. If you don't have sufficient access by a bank to the deposit and transaction system of record and other crucial information and the data maintained by the third party, it really can impair the bank's ability to determine its obligations. In some circumstances, uncertainty can result in delays in end users' access to their deposits. So as I said, with that bankruptcy, there was, accounts being frozen, which can, in turn expose the bank to additional legal and compliance risks. Another area in the compliance is just third parties performing compliance functions. So really that reliance on third parties to perform regulatory compliance functions may increase the risk of the banks not meeting its own regulatory requirements. So as banks and looking to partner, really understanding who's responsible for it. And we've seen kind of in our own practice that banks are passing it down into those partners that they're partnering with. They're really trying to understand. If you would have asked, a couple years ago, they would say, oh, our third party does it all. But now there's a lot more scrutiny to really understand who's doing it, and they want to see that it's being done so that they can meet their own regulatory requirements. Another area within the compliance is just insufficient risk management to ensure that the consumer is being protected. When there's insufficient oversight of these arrangements, it may impact the bank's compliance with consumer protection laws and regulations. So, Regulation E or some of those other ones may put the bank at additional risk. And just lack of controls and contracts. I think Louisa mentioned earlier, there's a variety of different contracts that can happen in different multiple levels. So really understanding if you're partnering with a third party, is there subcontractor relationships? Do you understand who that third party is utilizing? When they don't have direct contacts, when the bank doesn't have that direct contract with the entity, there just opens up additional risks. So really understanding, is there subcontractors that your third party is using? And then just lack of experience with these new methods. So arrangements that are leveraging new technology or new methods of facilitating deposit products and services really does open up, a risk to the bank and the management. Do they have the experience and understanding that there's additional risks, and are the banks taking that into consideration? And then, of course, from our perspective, and the concern from the regulators is just lack of sufficient audit scope and coverage. So really understanding, as you're determining your scope and the procedures you need to be doing, has it adequately addressed the oversight of these arrangements? And is it reducing kind of the risk to the bank? So taking all those into consideration are some of the highlights for the compliance that the joint statement came out. Now, when we talk about growth, the risk is that the third party may be incentivized to promote growth in a manner that's not aligned with the bank's regulatory obligations. So we know, that if you could get a lot of deposits and you could grow this deposit base quickly, especially with, the technology that's available at all of our hands on our phones and all of that, there could be some consequences and additional risk that that's not being considered. And then just the lag, rapid growth as a result of these arrangements may result in risk management and operational struggles to keep pace. So you may not have thought that you could double in size, and now you're kind of behind the game from some of those items. Also thinking about it from a bank's perspective, just the financial risks from funding concentration. So when you see a significant increase in rapidly increasing funding, is there concentrations that you may not have thought about before and that need to be considered? And does it add additional risk? And we know with kind of last year's liquidity and funding risks, this continues to be a focus and a high area that needs to be addressed, and ensuring that that's being considered when you're looking at kind of the risk of entering into these third-party contracts. And with that, with liquidity, just the pressure on capital levels, material and rapid balance sheet growth without kind of a capital formation. Thinking about that is, a concern to the regulators right now. And then the end user confusion and misrepresentation of it. So potentially misleading statements and marketing. So they're concerned, does the end user actually know where their money is, and are they FDIC insured? So do they have access to their funds? Do they have the insurance? Does it protect against losses? And, they really wanted to highlight and put out as well that, third parties do not have the same FDIC insurance coverage. The individual bank has it, but if the third party fails, then there's not the coverage, but if the bank fails, then there's coverage. And we've talked a lot about kind of all of the negatives or in the enforcement actions. A group compiled a list of data, and I thought it was pretty interesting that this quarter there was about 13% of publicly announced enforcement actions by the regulatory agencies were against fintech partner banks. So this is actually quite down from the last quarter, or the first quarter of the year. That was at 35%, and then 26% before that quarter. So we're seeing a slight decrease on the enforcement actions, but I expect that they're continuing to look at it. And when we think about those enforcement actions and being against those fintech partner banks, it really only represents 3% of the banking industry. So we're seeing, if we're talking about Q1, 35% of the enforcement actions were against fintech banking partners, but it's only 3% of the industry. So continued focus from that perspective on the regulators. And as you know, as we rethink kind of what happened and what has transpired over the last year, lessons learned that are key things to be considering. There was a roundtable where they asked industry experts to offer their views on guardrails banks and fintechs can put into place, and to ensure that we don't have another, mass bankruptcy or other issues that are occurring. And Louisa mentioned it earlier, proactively assessing your account reconciliation process and the gaps in that process. In that bankruptcy firm that had that, the situation was fintech's customers' inability to access funds was really caused by the reconciliation problem between the bank and the fintech. The pooling of fintech customers' funds into a single account or FBO account opened up the opportunity for reconciliation discrepancy. So it's really important to understand who is reconciling accounts, who is tracking that individual customer account. And banks really shouldn't just be relying on fintech partners to safeguard users' account data. It should be on the bank to have a line of sight of that account data as well. Bank partners really should know, know your customer, know your business information about the fintech's customers, instead of just relying on that fintech to safeguard it. One way to get around, around this would be just shared ledgers that banks and their fintech partners can access at the same time. This could be part of one of the answers or solutions to ensure that both the fintech and the bank has the same information and access to it. So that's, an area that could help with the reconciliation process. Another area that they thought, from lessons learned, is just maintaining fintech user eligibility for that FDIC deposit insurance coverage. As I said, fintech account holders are eligible for the pass-through FDIC insurance if the underlying bank fails and if other conditions are met. But eligibility for that really depends on the banks and the fintechs maintaining good records about the account holders, including information on who owns the funds. And again, the FDIC recently issued that warning to customers that said the FDIC deposit insurance does not protect against insolvent or bankruptcy of a non-bank company. So really making sure that when there's communication going out, marketing material going out, how's that being marketed, and do customers really understand? And then they said, lessons learned, just acknowledge the investment needed in compliance and fraud mitigation. There's just heightened, awareness of that. Partner banks that moved too quickly relied too much on their partners to meet some of those regulatory and compliance issues. And now there's been sanctions and risks related to that. Really just now, rethinking the business risks, the concept of business continuity and disaster recovery, pre the collapse of the company were typically associated with natural disasters and how would that happen and get back up and running. But now really thinking about, is there plans in place to incorporate if there's a third party risk associated with a collapse of the company, and what does that mean for kind of the customers? And then, I just think before we move on to a polling question that, while banks carefully evaluate potential fintech partners, it's just as important for fintechs to vet the prospective bank partners as well. So it should go both ways. And a fintech should evaluate by looking at the questions they're asking. So if a fintech is looking to partner with a bank and they're not asking kind of questions or what are their fintech's processes and compliance, then the fintech should maybe raise a red flag and wonder why they're not getting the questions from their fintech. Laura, I think we have our next polling question.
All right, great. Yes, question number 2, has your company completed an IPO? A, yes, B, no, C, I don't know. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And also feel free to submit your questions in the Q&A box located on your console. All right, and we'll give everyone just a few more moments to respond. And here are the results.
Okay. Looks like about 23% has completed an IPO, and majority is no. So now that we talked about the regulatory side, we have gathered information from our fintech clients on things that they wish they knew. So we kind of focused on the bank side. We thought we would focus a little bit now on kind of the fintech journey and the things that we've heard. I wish I would have known. I wish I would have thought of that along the way. Early stage opportunities and threats when we're thinking about, a fintech that's starting up. What are some risks there, and what are some opportunities from that? And so thinking about, kind of state and local tax nexus, those types of things become a bigger focus, especially if you're doing business in multiple states. There is a minimum level of activity in a state that requires a business to collect or remit sales tax from customers from there. So it becomes as you continue to grow and the fintechs grow, understanding that there are great opportunities for tax credits and R&D credits from that perspective. So trying to look at that as you're growing as a fintech, is there opportunities to be able to utilize some of those items? One area we've seen a lot, and I've seen it with a lot of my fintech clients that I work with, is just that growth and morphing of products and of a company. A lot of the fintechs that I worked on, when they started out, had one product or one item, and they morph so quickly. We know technology is ever changing, and it just goes so fast. So really understanding, do you need to reassess, the people that are involved in the company, the talents that are still there? Are there new compliance regulations that you did not know you had to abide by because of the morphing of the products? So when you're partnering with the banks and the fintechs, really understanding, is that fintech morphing? Do you understand what products they're offering now? And is there processes and procedures in place to understand that? If you're thinking about new products that are being added to kind of the portfolio or options to customers, have they been fully vetted? Are there regulatory hurdles? We've had, several folks come to us that didn't realize that they had to do some kind of compliance exam, and now they weren't prepped for that. They didn't have the resources internally to be able to answer those questions from the regulatory body. So really understanding and taking inventory of what products have you added, what are you doing to ensure that you have processes in place. And thinking about it from kind of the assurance side and auditing side, is that you may need to reevaluate and reassess your accounting policies that are in place. So as a startup and a fintech, you may have one product and one revenue stream, and then all of a sudden, a year later, you've added all these different revenue streams. So from that perspective, just really understanding, do you need to go back and understand our revenue recognition, deferred revenue, any of those types of things, to really understand, are you recording it correctly and reporting it back to your stakeholders? Also, as fintechs are growing, there's just going to be a higher bar to get, additional investors. Those investors are expecting, more reporting. We typically see, a few years in from a startup, there'll be requirements for audits to be done. They want to see financial reporting. They also want to understand, the SOC reports. Does the company have one of those? And a few other things, that fintechs kind of on the journey, the things that we've heard from our clients that they wish they knew, is just really, the time to exit and that strategy. So I know 50% are not on the call, are not public, but really, what is the exit strategy of the fintech? Are they looking to go IPO? Are they looking, for a strategic exit? So that requires planning. Usually we say 2 to 3 years to get to that exit, whatever that exit strategy may be. Usually, there may be those audits that I was talking about, or going public takes, 18 months minimum to be able to get all those controls and processes in place. Again, legal, regulatory, accounting assessments, really understanding independence, all of those things are items that we're hearing that they wish they would have known. Data security and integrity audits, as we see more and more of those regulations being pushed down, really understanding, do you need to have a SOC report? Do you need to have kind of your data and your integrity of your information being audited from that perspective? And of course, unreconciled differences or accounts, we know that's a big area of who's responsible for it. Has it been done from that perspective as you're looking for that exit strategy? We talked a little bit about, and Louisa did say too as well at the beginning, researching kind of your business partners, really paying attention to those business partners and understanding who they are. The banking partners are under, are they under regulatory orders? Really looking at that from that perspective. And, from a bank perspective or a fintech, really looking at that ability to continue to go, to continue as a going concern. You want to understand, what does your partner financial situation look like? Is there risks that you're not taking into consideration from that perspective? And I just want to remind, everybody in the audience, there is that Q&A. So before maybe we pop into another poll, if there's any questions, feel free to put it in the chat. It's not visible to the whole group, it's to us. So happy to answer any questions from that perspective. Otherwise, maybe we'll go ahead and move into another polling question.
All right, great. Thank you, Theresa. Yes, polling question number 3. What is the biggest challenge you face in the fintech banking partner relationship? A, regulatory compliance. B, FDIC insurance. C, SOC reviews. D, none of the above. E, all of the above. For those of you who would like a copy of today's slide deck, you can download them now from the folder that says slide deck and handout. We will also be sending the slides via email after the webcast, along with the recording. All right, and we'll give everyone just a few more moments to respond.
We did get a question a bit in about the polling question. This is polling question number 3, and there are 4 polling questions. So to get your CPE, you will need to complete 3 of those 4.
Yes, perfect. All right, now let's pass to the results.
Great, it looks like a nice mix of things, with the regulatory compliance being the primary concern and challenge facing everybody, which makes a lot of sense. And that's kind of why the bulk of this presentation and discussion was centered around those risks and how they are changing, and new information comes out very, very frequently. So makes a lot of sense. With that, continuing on with kind of the things that fintechs have shared that have been either difficult or challenging as they're going along in their journey. And this continues on with what Theresa was saying. But just as you are growing, thinking about your own strategies, let alone how you're working with a banking partner or whatnot, even if you are not, but just the growth cycle and things that are in place when you're a startup company, they tend to be, you're just getting by. You have a limited number of people, you have a limited number of resources, you have a limited number of funds to spend. And so oftentimes you're going to start with, what's going to get you by. And so financial records, accounting systems, also not the most fun thing to spend money on. We understand that, but they can be very important. But, let's say you're starting with Excel or something like that, or maybe a slimmed down version of QuickBooks, and that works fine and it suits your needs. And that's great. As you're growing and as you're expanding, thinking ahead to the time frame where you might need to invest in a different accounting system that has more capabilities, more reporting. Chances are, Series B, C rounds, depending on where you're at. Again, there's different levels of information that your management team might want, that your investors might want, your other stakeholders that you might be sharing information with. So thinking ahead to be able to convert or, have the right systems in place to help you grow and not experiencing a hiccup, when it's too late or making rash decisions is helpful. Also, as you get ready for an audit, understanding your financial system and records and how things are processed can make that a whole lot easier, and avoid a lot of different adjustments and things like that in the process. Some of the things too, just in the initial stages of an audit, and I understand, those of you that have gone through an IPO, this is, maybe you experienced the same thing during the IPO process or during your first couple audits that you're likely have moved beyond. But a lot of the startups, you're expensing things as you go, you're tracking things more on a cash basis, may or may not be GAAP compliant. And so some of the things that we see where we see the most adjustments or discussions around when you're getting your first audit is software capitalization is one of them. A lot of development expenses, they're just expenses, whether they're offshore or, just your development team here, your technology folks. How you're tracking those and some basic record keeping behind that is really helpful. And it can go a long way, even if you are not capitalizing it until you have an audit. Having the information or having some capability to go back and see what stage you're in. Am I developing? Am I testing? Do I have a product? Am I using it, selling it, tweaking it? That has different ramifications for financial reporting. And so, being able to kind of build that back out or building it out along the way can go a long way, make the audit process smoother. Unreconciled accounts. I know we've talked a lot about that from different angles, either just from the partner relationship, but as your own company, it's important to be able to be balancing your own cash. You could be an intermediary, flow through of millions of dollars, yet your company is small, but that takes a whole lot of record keeping and a whole lot of reconciliation processes in the background. So making sure that you have that capability is super important. Equity structures can be very complex, and that's super important. Just, that's the cash you're getting from either your board members, your investors, which can be a variety of individuals, equity funds, banks, et cetera. And there's different structures and types, and they have different sweeteners attached to them, which can be very complex. So understanding from a GAAP standpoint how that plays out, keeping accurate cap tables, including the warrants that you attach to some sort of debt arrangement or equity structure that may not have been, converted yet, but being able to track that or know the impact is very important. From a GAAP standpoint, there's a lot of complexity associated with warrants, convertible debt, convertible preferred, convertible, everything. And it can have different treatment from a GAAP standpoint than how you're looking at it as a company where, hey, I got some money. But from a GAAP standpoint, maybe it's a liability, maybe there's fair value considerations. And that's where 409A valuations can be really helpful. Oftentimes as a fintech, you don't have necessarily, you're not concerned per se if some of the equity is treated as a liability. It was still cash. Its purpose was to fund operations, et cetera. But there's the reporting side of it where maybe it does get fair valued, where 409A valuations can, depending on what you engage them for, can be specific to the type of preferred share, type of common share. And that can allow you to, keep track of that if you need to, if there's an audit point. Or for example, what's not on here, stock compensation. You can use those to help price your options, price the share awards, or in some cases, profit interest, things like that. So they can be really useful, just aside from valuating the whole company, just to helping with the accounting as well. So there's different considerations there. And just the pain points of this whole process, and not that, audits are a pain point, but just being able to make that a smoother process. There's tools, and likely you're the creators of some of these tools, but we see a lot of our bank clients using software now to help with their own reconciliations, where they're taking a whole lot of data, and then comparing that back to their own records, and the software helps do that in half the time that the manual process was taking. that can be applied to your own company as well. And just using the technology to build solutions to make this process easier, help with the tracking of software, help with, cap tables. There's software available to help with the equity tracking. It can be super detailed. There's tax implications for the holder of some of these items. And so, utilizing technology to help with some of these pain points can be really helpful as well. Finally, this is a great slide. I'm sure none of you can see it because I can't see it, but I have seen it. And what it does, and it'll be in your slides, so you'll be able to download that or maybe expand it to a large enough size. But it is helpful in looking at the whole process or life cycle, I should say, of your company and where that's at and different things to think about along the way. And if you're growing super fast or getting more funding, or hey, I have an IPO date, my goal is 18 months from now, being able to backtrack that and say, hey, where am I at? What do I need? Do I have these things in place, or what do I need to invest in or spend some extra time doing so that I have what I need so that it goes smooth? There's a lot of things that can happen. IPOs, acquisitions, they don't always happen timely. And let's say, for example, you're dealing with a banking regulator, even just typical bank sales with two banks, the regulators are involved in that, and that can take a long time. It has been taking longer over the last year or so to work through those. So when you're adding the complexity of a fintech per se, that can add, being ready, being able to answer those questions, that can be helpful as well. So that's the point of that one. And then I think we are heading into our final polling question. Or
maybe before we head into that, Louisa, there was a couple questions. We had mentioned earlier that it was important to have multiple banking partners. And the question was kind of, why have multiple? So do you want to go in a little bit more about why it's important to have multiple banking partners?
Sure. So, along the lines of growth and, a lot of the banks have specific measurements or tolerances or policies in place as to how much of any sort of concentration, whether that's loans of a certain type, whether it's, CD funding or non-interest bearing deposits. Typically there's no limits on those, but anyway, so there's different tolerances, whether it's regulatory driven or whether it's just board policy management comfort. And if that's your only partner and they've said, great, you're small, we can handle $5 million of these types of loans. Well, if you're growing, you're expanding your services, you have another platform that's growing a different type of lending per se, you're going to get stuck and they're not going to be able to fund those loans, or they're saying, hey, we have enough of these types of deposits, I can't take any more. And so that can be a risk just from a concentration standpoint, but just with the regulatory side of things, some of them actually have regulatory concentrations, regulatory limits on concentrations or activities. Or from a risk management standpoint, if the regulators during an examination come across, something about the relationship or the contract that's uncomfortable, or something that's in it's not being performed correctly, some of the compliance aspects they'll find issues with, that's when the consent orders or the enforcement actions come into play. And that's when they can just be forced to stop mid-contract. You have a contract, a legal contract, but they can actually there'll be a breach of contract. They're not going to fund any more loans. So that can put your own business at a huge risk if you're relying on that partner for those funds or the payments, processing, et cetera. That can have a huge impact. And so it's important to have options for your own business continuity process, let alone just having the ability to grow in case one of them gets in trouble as well.
And I think we do have one more polling question, but you did mention, consent orders. There was a question when I was looking through what should, as a fintech, what should I expect from my banking partner as a result of these recent consent orders? What should the fintech be thinking about?
Yeah, they're helpful because they're public. And so by the time they're public, they're out there for you to see. So you can see what the regulators are saying, stop doing X. This is the issue coming from the regulator's perspective. May or may not all agree, but nonetheless, you can read and see what those issues were and say, hey, do I have a similar structure? Do I have these things in place? Talk to your banking partner and see if there's any changes that you need to make or what you need to do to be ready and prepared to avoid something like that. Or obviously you can't help their side, but just having things in place so that they're also able to answer the right questions for the regulators and have the right things in place so you can continue your relationship. So the consent orders have a big impact. And there's clearly a lot of scrutiny on these relationships. So the more that both sides are aware and know what's expected, the better the partnerships can be and keep growing the industry and moving everything forward. Hopefully that answered that question.
Yes, thank you. And I think we'll hit our fourth polling question. So we'll have Laura advance to polling question number 4. Reminder, 3 of the 4 is needed for the CPE.
Perfect. Yes. Number 4. After today's presentation, do you plan to make changes to your readiness assessment? A, yes. B, no. C, I don't know. As Theresa mentioned, you have to answer 3 of the 4 questions. And once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window. All right, and we'll give everyone just a few more moments to respond. And now we'll pass over to the results.
Okay. So it looks like it's pretty split from that. As we're kind of wrapping up, we did have a few slides here for resources, but really I think, this was kind of high level. Really wanted to talk about, as you're partnering and thinking about those relationships, entering in, with a bank partner, multiple, as Louisa said, is always the best to be thinking about. There's so much information out there. There's going to continue to be the regulatory scrutiny and really having a plan in place and understanding that. The resources out there, as Louisa said, those consent orders are out there. So really understanding what is the focus and what is being looked at from a regulatory perspective is huge. And, from the fintech side, really understanding the struggles as you're starting up, understanding what your end game is and how you want to, help bridge that gap between the banks and what the product you're offering is going to continue to be important, and having open dialogue with your partners. And we have included within the slides some of the resources and areas in there. Louisa, any comments kind of on the resources that we have listed out?
No, those are just a handful. They're centered mostly on the vendor management area. I think that the newest one, we'll need to add that in there, but we'll make sure we provide that out to the group just so you have that as well.
Okay. I know we probably didn't get to all the questions that were asked today, but again, we'll kind of look over that. They are being recorded. So if you had a specific question that we weren't able to hit on or we didn't cover within here, we'll try to reach out to you and get you an answer from that. And Laura, I think I turn it back over to you.
Perfect. Yes, thank you both for a great presentation today. Like she mentioned, if we didn't have time to answer your questions, we will do our best to follow up with you after the webcast. Feel free to reach out to either of our presenters if you have any additional questions. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. We invite you to visit our website for more resources and information on this topic, many of which are linked in your handouts window. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate, and a copy will be emailed within 3 weeks should you have any difficulty downloading it now. And finally, here is a link to a survey for today's presentation. Your feedback is always appreciated. Again, thank you so much for joining us, and take care, everyone.